everyone, welcome to the Bordeaux Blend. I'm your host, Sean Vanderwall, and we are blending expert ideas and tools to help people improve their everyday financial decisions. Today, we're jumping into venture capital as an asset class and the many considerations that come along with investing in that space. And just to aid in that conversation, I've asked Samir Kaji to join us today. Samir is the CEO and co-founder at Allocate, a platform that provides curated access to private market investments, due diligence tools, and advanced portfolio optimization. Samir, thanks very much for joining us. We really
Yeah,
appreciate it.
thanks for having me, Sean. Good to see you.
And I wanted to jump in a little bit into your background first, so people know a little bit who you are under the hood. Of course, there's the bio that we can read online or point to that says, "Hey, Samir's got over 20 years of experience, really working with venture capital firms, and especially on the banking side. You were at SVB and First Republic." But prior to that, can you give us a little bit of history about where you started, where you came from, education-wise? How'd you get involved in this space to begin with? It's not an easy one to break into.
Yeah, it's a great question, and I saw you led with the two banks that are no longer around as my background, which is a very different conversation than maybe 6 months ago. But grew up on the East Coast. Actually, lived in New Jersey, Virginia Beach. My dad was a civil engineer. Ultimately, decided he wanted to be in real estate. Started his own commercial real estate firm in the '80s. So in the early days, we would just move wherever his projects were. So we moved from Virginia Beach to Michigan to Chicago, and ultimately moved out to the Bay Area in 1983. And at the time, my dad actually was thinking about doing properties here in the California, realized Texas was a better opportunity, but we were done moving. So my dad used to commute back and forth from Dallas Fort Worth to California at least once a month. I ultimately went to school here locally, graduated in '99, and really had this unique opportunity to either join my dad's family business and be on the commercial real estate side, or do something completely different. And if you remember the late '90s, this was when the internet was in full tow, and everyone was talking about .com. And I had this really interesting opportunity to do something different, which was join the tech industry. And at the time, a bank called Silicon Valley Bank, which back then was around for 16 years, was the only real institution that was serving the innovation economy. So working with early stage entrepreneurs, working with VC funds. And I joined that during the dot-com era. I actually was lending to dot-com companies through 99 and 2000, and then spent about 3 years post dot-com collapse actually acting as a distressed lender, so working out a lot of the deals. But through that tenure, I was there for 13 years, had the great opportunity to work with companies like LinkedIn and Roku in their early days. So meeting these entrepreneurs at the ground floor and being along with the journey. And I just had a lot of fun doing that. Did that through most of my tenure there. And then late in 2009, of course, during another economic dislocation, moved to the private funds group. So that was working directly with the VCs. We also invested in those VC funds through our SVB capital arm. Had a great time. Went through, 2 cycles in a very short amount of time, and then, joined First Republic in 2012 to start a group focused on venture and startups. Was there for 8 years before starting Allocate in 2021.
Before we jump into Allocate, because that's a really interesting platform and I know many of us are excited about, I wanted to quickly pause and just come back. I know you've been through a couple of cycles, but what sort of commonalities, just as a backdrop for listeners, did you recognize or observe in the tech bust in kind of 2000, 2001, in 2008? And how do you draw any sort of commonalities from today's market and what you're seeing there?
Yeah, so going back, and in the one that probably people draw a more clear corollary to is 99, 2000, which was really technology driven. 08, 09 was more real estate driven. And of course, technology was a consequence because the entire market did drop. And actually, venture funds only raised $16 billion in 2009. This market was a sustained period of zero interest rate policy coupled with both monetary and fiscal policy, right? So when you have money that's very easy and you have a lot of supply of capital, typically growth areas are the ones that get affected most on the way up and on the way down. So what we saw in 2020 and 21 post COVID and during COVID was an enormous amount of capital coming into the market. people chasing yields. We saw public market multiples explode, to 20, 30, 40x forward-looking multiples, and that changed how tech was viewed. Now, almost any company was viewed as you can be a billion-dollar company. And in the tech world, these billion-dollar private companies are unicorns. And in 2013, there's like 4 unicorns. In 2020 and 21, 700 new unicorns were minted, really as a byproduct of so much capital flooding the system. So in many ways, it felt like 99 and 2000. The main difference, though, is back then there was about 250 million people on the internet. Today, all of us are connected all day long using our smartphones, and technology has now gone through multiple cycles. The mainframe computing, personal computing, the internet, mobile and cloud, and now AI. Of course, we're hearing a lot about in terms of new ways for industries now to operate. One thing that's always clear through cycles is at the tail end of the cycle, investors run into fear of missing out. And there's always this belief that everything is going to go up and to the right, and there's always going to be another buyer ahead of you. And what it showed is like the macro actually does matter, and technology cannot operate in its own bubble and continue to go up and to the right. And so in many ways, this felt like 99, 2001. 08, 09 was hard because like after 09, we saw rates go to zero. Like I do not see that happening again. In fact, I think the years ahead, we're going to see more stable interest rates that are more based off the pre-2000 period versus what we've seen certainly over the last 10 years.
Yeah, absolutely. I mean, that's helpful context. But just to fast forward here, back to Allocate. So you've had this incredible history, a lot of experience to draw on, especially through these market cycles, which is helpful, especially for a lot of newer VCs or people who are investing in venture funds who think a lot about what happened just in 2021. And you saw huge multiple expansion, now compression, and people are thinking about, how to opportunistically maybe buy some high quality assets at a discount. And of course, platforms like Allocate can help with that. So what is the gist of Allocate? How are you actually helping people and institutions really get access to this asset class, and especially in a space where there's a huge variance and difference between what the average and median funds look like versus the top quartile versus the top decile?
So the last is a really interesting point to maybe double click on. So if you look at public markets, you could have different managers that are within 1 or 200 basis points of each other. In the private markets, there's much more dispersion based on first quartile, second quartile, third, and fourth. VC is the biggest asset class when it comes to a return dispersion. So top quartile VC from 96 to 2021, averaged about 24.6% net IRR to limited partners. Top decile was 41%. Bottom quartile was sub 5%. So in order to consistently succeed in the world of venture capital, you have to be above median. Median's about 13%. But really you need to be in that top quartile or top decile. And in order to do that, you have to consistently, find managers, access managers, be able to diligence managers, and build a portfolio that has diversification across time and manager types. So one of the things that I saw in going back to my first Republic days, we had 3 legs of the stool. We had private banking, commercial banking, private wealth management. And within private wealth management, it was very clear from 2012 on that our clients, which are very much like your clients, were looking to park some of their capital in the private markets. So whether that was private equity, venture, private credit, but there wasn't really good on-ramps to do that. And the private markets are really opaque. Venture still acts in many ways as a small cottage industry where insiders and institutions get the opportunity to invest in the best funds. Now, as the market's changed, it's not just finding those obvious brand names, but it's also finding those undiscovered gems, the niche managers that have performed, that have some kind of unique comparative advantage. And our view was that an average individual investor simply didn't have the resources, time, balance sheet, technology to really do this in a programmatic and responsible way. So Allocate was founded on this principle that we believe the private markets are going to get bigger. the influence of the private wealth sector within those private markets is going to be higher in terms of participation, but the tooling for individuals to successfully participate has been fairly lacking and antiquated. So we offer advisors the ability to onboard really high quality assets and do it in a way that's technology forward, where everything from subscription documents to reporting to miniaturizing the check sizes are all part of evening the playing field so that people can invest in venture capital in a way that gives us the best shot at getting that top quartile or top decile performance and investing like an institution.
And how do you help people, I suppose, or friends or family members that are starting to look at that asset class? Maybe they understand the stock market, they own some stocks, they own some ETFs, mutual funds, maybe they index or something like that. How do you help them contextualize venture capital and reframe that so that they can really incorporate that into their long-term plan? And we hear, terms thrown out there like the power law and the Babe Ruth phenomenon, but how do you really help them relate to that? And include it appropriately and sizing that position appropriately within their broader portfolio.
Yeah, so it's very individual based. Everyone has different risk return parameters, different liquidity needs, and they have different opportunity costs. So ultimately, the way we think about venture capital is that looking at the last 25 years, what's happened is, private companies within technology and life sciences stay private longer. We've gone from a median age from inception to IPO of about 5 years to now closer to 8, 9, 10 years. And, the companies like Amazon went public 3 years after being founded. So in the 90s and early 2000s, you could get access to the technology sector by simply waiting for a boutique investment bank to take these companies public. And there was still a lot of upside. Now you have companies like Stripe, right? Stripe is in the private markets well after it was founded at a $50 billion valuation. So in order to get an earlier stake in these companies, it's really venture capital that funds these companies. So I just think about you're investing into private stock at a different point of the development cycle. So when we talk about now, how does this pertain to the public markets? Well, there is this concept of power law, which you mentioned. And in a venture fund, an early stage venture fund, you typically have 25 to 35 companies. You're investing at the early stages. And when a VC is looking at an early stage company, the calculus they're going through is, can this company return my entire fund? If you look at the distribution of returns, it's usually the top 5 to 10% of a portfolio that drives 80 to 90% of the fund's returns. So, if you invest in Google at that seed or Series A, you invest in a Twilio, you invest in a Snowflake, that one company could have a 50 to 100x return on your capital. So if you look at loss rate, it's not in VC, it's not about the loss ratio. You might lose, on 50% of the investments you've made at the early stages, but it's the magnitude of the wins. So we also look at, is a manager consistently getting into these entrepreneurs and these companies that are producing outsized returns? And we've seen certain funds that have returned a 300x, a 50x. Now that's not usual. That these are massive outliers, but it's typically off one or two companies that are generational companies. And that's the big difference from VC to private equity, where in private equity, you don't take a lot of losses, but your upside is capped because you're typically investing at the later stage. You're turning around those companies in 4 years, and maybe you get a 2, 3, or 4x, where in VC, every company, when a VC looks at it, it has to be, can this be a fund returner?
Yeah. And by returning the fund, just to clarify as well, that's if everything else essentially goes to zero, that one investment will give me my money back at
Yeah,
minimum.
and I'll give you an example. So let's say I raise $100 million fund, and my average check into an initial investment is $1 million, and then I reserve a little bit for follow-on investments, and I get 10% of the company for a million. The first round of capital, $10 million valuation, I put a million, I get 10%. Over time, I'll get diluted as the company raises more money. But let's say I get down to 5% when the company IPOs or goes through an M&A. So for me to return $100 million and I own 5%, that company needs to exit for $2 billion. But if it exits for $2 billion, I've returned the entire fund. If it's a company like a Stripe and it's a $50 billion exit, now I've returned potentially 25x my fund with a single investment.
And I know in a similar vein, you were talking recently on Twitter about, someone published something and there was this graph floating around. I don't know what the origins of it were necessarily, but a breakdown basically of how venture funds actually generate performance results. And I think there was a range, it went from basically losing your money, which represented maybe a third of the portfolio. I don't have the exact numbers
Yep.
offhand, up to maybe at best you're kind of have a 3 to 5x return. And you said, look, no, not at all the case. And, here's Andreessen Horowitz did a good article on this, basically looking, as we talked about, kind of top quartile funds where the distribution of those returns, you'll have some investments that are kind of 30 to 50 times, their original investment, which will, if not return the fund, certainly get you most of the way there, with the goal of having, a small handful of those that you're really going to generate all the excess returns from. But just to come back to that, what were some of the issues that you saw with, this, I would say, very general framework or heuristic for venture in general, and how would you correct that misconception?
So there's probably two things that I took note of and maybe corrected. So the first one was there was a there was a graph that said, okay, if I return a 3x on my venture fund and it takes me 10 years, I get a 12% return. And that would be true if it was all the money going in day one and all the money going out distributed to the LPs in year 10. In truth, venture funds are drawdown structures. They typically call over a 4 to 6 year period. And then distributions typically start in years 5, 6, and 7, depending on the strategy. And so a 3x net fund, which actually top decile, that's top decile for this 25-year period, 96 to 2021, was 3.06. That is close to a 30% plus net IR, depending on cash flows. And so people sometimes forget that in the public markets, if I get a 3x over 10 years, that is actually a 12 or 11 or 12% return because it's buy and hold. And, when people say, well, you can get liquidity, you're not taking into account that if you do exercise liquidity, you might be selling at the wrong time, you might be buying at the wrong time, and there's a lot of inter-period volatility. So if you look at buy and hold, 11, 12% versus venture top quartile, significantly higher. The other thing that I, would mention is like the distribution of returns and what this means for venture funds. People think, well, if I invest in a venture fund, I could lose all my money. Well, that would mean every single company in the portfolio has gone to zero. Statistically, what they've shown is once you get up to about 22 to 23 portfolio companies, you get about 85% of the total diversification benefits. If you're at 50 companies in a portfolio or 80 companies in a portfolio, you're almost guaranteed a mean return. Not median, but a mean return, which has historically been between 16 to 23%. And that's because of the fact that you are going to catch a few of those outliers. And so when, people have these, dire sort of statistics, and say 90% of companies fail. Well, 90% of venture companies do not fail. And it's the definition of failure. Like the way I look at it, a failure is a complete loss of capital. And that's a zero. That is a complete failure. But as a venture fund, that's okay, so long as you have the magnitude of returns from that small part of your portfolio, which again, at 25 to 35 companies, statistically, if you're a good manager, you are going to hit on 1 to 4 companies.
Yeah, and I think it's important you mentioned, some of those returns and top decile funds being a little over, 3x net of fees from their initial start date. And I think that's important because when people are thinking through broadly what their options are, whether it's public stocks and they're just buying an index fund, right? If your average returns there, depending on the time frame that you're looking at, are kind of high single digits, call it 8 or 9%, you expect to be compensated for the illiquidity of investing in private companies. And if you aren't getting that, and oftentimes people might say, look, if it's just going to be an average venture fund, then I'm probably better off just sticking with public stocks because I have the flexibility in the liquidity. I don't necessarily need to worry about locking up my money for 10 to 13 years or whatever it might otherwise be.
I agree with that. I agree with that. And there's other things you can invest in. You can invest in a private credit fund, a private equity fund, where your liquidity is going to be brought up by 2 or 3 years, given the hold periods. So you're always looking at, what does this do within my portfolio? Am I going to get a premium for the illiquidity? And risk depending on the structure of the fund and the type of fund it is to justify going into a longer term illiquid asset category. Now, people look at it differently. There's this concept of PME, which is public market equivalent, and what is the necessary public market equivalent, or alternatively, what is the total yield that I need to get above and beyond the private markets? I'm sorry, public markets. And I wouldn't look at the S&P, Nasdaq, or QQQ are much better proxies for looking at a relative return sort of profile in the public markets to venture.
Yeah, and just talking about different asset classes, I want to shift quickly because I think this was a really good thought that you had and isn't one that I think frequently comes up, where you said you're almost thinking about early stage, growth stage, late stage ventures almost as different asset classes entirely. So could you help people understand how you're thinking about that and as it relates to actually putting money to work? I mean, is it as easy as finding a fund that is across a multi-stage, or are you trying to piece together optimally, these different early stage, late stage areas of the broader venture capital market?
Yeah, this is probably the biggest area that venture has shifted. So 20 odd years ago when I started my career, VC was a monolith. It was a single sort of asset category where almost every fund did the same thing. They would invest, the first round of capital, they would follow on to that company through multiple rounds, and they, raised a fund that was between 250 and 750. And it was kind of rinse and repeat. Maybe there was some changes around the margins in terms of telecom versus internet, but ultimately everyone did the same. And then when mobile and cloud started, VC started to mature and fragment. And then there was something called seed stage financing, which was historically like angel investing. And then seed stage became an institutional class. Then there were early stage. Then there were some firms that became platforms. Those are like the Sequoias, the Andreessens, the Lightspeeds. And they started to run multiple products, different geographies, growth stage firms, sector focused funds. And ultimately, now you look at it and it's a completely fragmented universe of VCs. So, like when you think about VCs, there's about 4,000 active ones in the US, but there's a big difference between a $50 million pre-seed fund that's investing first capital into a company at inception versus a Tiger Co. 2 that is really investing at the later stages primarily. And you have different risk return characteristics. And so when people are looking at building your portfolio, the first thing, we ask them is, what are your return objectives? Why does venture fit into your portfolio? Do you have, a view of like tangibly and intangibles? What are you trying to get? And then within that, somebody may say, I really want to shoot for the moon for my venture portfolio. Well, that means you're going to have to fly closer to the sun, take a little bit more risk. Maybe it's direct deals. Maybe it's doing all early stage seed funds that are smaller, that may have a little bit more volatility, fund over fund, but have much higher upside because of the pure calculus of the math of returning a 4x on a $50 million fund versus a $2 billion fund. And so, I think that a well-balanced portfolio probably has a little bit of everything. So some growth, some early stage, some multi-stage. But at the end of the day, the key thing is manager selection in any one of those pillars that you're looking at.
Pertaining to manager selection, I think one of the harder parts is diligence, especially for emerging managers. You talked about, hey, someone has, a $50 million fund, they're focused on seed stage, especially when this might be, fund 2 or something like that. So they've got a little bit of track record. They've got a little bit to show for it, but maybe they haven't distributed any sort of dollars yet. What are some of the things that you can do, and how should someone think about diligencing someone like that before they actually put capital to work?
Yeah, I think the biggest thing that we look at, if it is a fund 1, 2, or 3, because even if they're 3 funds in and it's been 6 years, it's unlikely they have any demonstrable results that are meaningful. The reality is venture funds directionally don't settle into their final quartile until about year 6 or 7. So it takes a long time. So what you're typically looking when you talk to a manager is a few things. The first thing is there a GP thesis fit? Meaning that is the general partner executing on a strategy that they're uniquely qualified for? And I don't mean, Sean, if you said, hey, Samir, I really like AI. I think it's cool. I'm going to go invest in AI companies. Well, what have you done in the AI sector historically? What interesting point of view do you have? How are you going to win the most interesting entrepreneurs without overpaying. So when you look at these venture funds, you're really looking at through the lens of how are they uniquely qualified and advantage when it comes to sourcing, picking, winning, and helping companies. And all of those things really, really matter. And so the questions we ask is, why are you doing this? Why this thesis? Why this fund size? How are you going to execute? We're big fans of people that are very systematic in their approach. This is what we do. This is how we do it. This is how we add value to companies. This is our decision making. And I think I've met maybe 2,000 managers over the last 14 years, and you start to really get a sense of the ones that have really thought about how do you be a great fiduciary, but how do you build a business that is so relationship oriented, and they're thinking around the edges. They're thinking about things that other people aren't. So you want managers that have a unique point of view that can allow them to have the conviction to do things that are maybe slightly contrarian. They're not just investing in momentum. And unfortunately, what we've seen over the last several years is a lot of managers deciding that VC is a great thing to do, starting a firm, but really just using it as a hobbyist adventure. And then ultimately realizing that venture is really hard, it takes a long time to be successful. And a lot of the investments that they've made now were momentum bets, which ultimately won't result in great returns for their LPs. So we want people that have long-term plans. We're getting married with somebody. If we make an investment in a fund, it's at least 14 years, maybe 12, but generally speaking, for an early stage, it's 14 years, and we're planning not only investing in that fund, but we have to feel that we're going to be a partner with this manager for multiple funds. In order to do that, the conviction you have to get is around the long-term orientation that the manager has, both in terms of investing, but how they built a firm. And this is something that's very clear in those conversations. And then, of course, on top of that, you have to also do a lot of reference calls. We call entrepreneurs, we call other GPs, we call other limited partners to understand what they are telling us is actually happening on a day-to-day basis.
What do you think about background as far as VCs go? And is there a common denominator for the more successful venture managers? Like, are they founders? Are they product people? Is there any sort of common denominator against their background there?
No, I don't think so. I think it's very individual focused. And, there's people that have been very successful as founder turned VCs, whether that's, people like a David Sachs from Kraft or someone like a Mark Andreessen, Ben Horowitz. There's also people that came from, other sort of asset categories. You have people like Mary Meeker, who was an analyst. You have Bill Gurley, from Benchmark, who was on the public side. You have somebody like Roger Ehrenberg at IA Ventures. Now he's retired. He's done so well. He did really well at IA and ultimately retired. But, he came from a completely different, asset category and went into venture in 2009. So I don't think so. I think it's more a function of, is the person doing what they're uniquely qualified to win at? Are they in the right swim lane?
Yeah, makes sense. So I think the other area, and you slightly alluded to this, but thinking about ways to manage risk, and in general, I think, correct me if you feel differently, with this asset class generally, it's just managing risk has a lot to do with the upfront diligence that you do and having a pragmatic approach to actually putting capital to work. So, for example, we typically try to invest like an endowment might, where you're setting kind of target minimums and maximums and bands for different sort of asset classes, and then you're thinking a little bit more tactically about how to back into whatever that target range might be. And that often includes time-based diversification or vintage-based diversification. So you said, look, maybe fund one to fund three might be a little bit too early, but we're going to try and invest. We really like this manager. We like the thesis. They've been able to show some demonstrable results for the what we can see so far. So we're going to maybe do fund five, fund six, fund seven, and we're going to allocate a portion to that. But how do you think about managing some of that risk up front, and how do you think about tactics like time-based diversification as far as implementation of that portfolio goes?
Yeah, so I mean, you do have to have some level of long-term orientation when it comes to venture. This is not an asset category where you jump in. Typically people jump in at the worst times when we're at the top of the market, or at least heading to the top of the market, and people start to flee. After the market dislocates like it has over the last 18 months. usually what happens when, people exercise that type of behavior is you get in on the worst vintage years and you miss out on the great vintage years. And if you look historically, after economic dislocations, better sobriety in the market, valuations come down, companies are forced to do more with less. It creates more healthy hygiene, both as an investor and as an operator. And so you have to have this long-term orientation. Now, it doesn't mean you're going to do the exact same every single year. Like if I want to do 10 million in VC over the next 5 years, doesn't mean I'm going to do 2 million every single year. But what I don't want to do is do 5 million the first 2 years and then do nothing for 3 years. Eventually, venture, like any other asset category in the private markets, you want it to self-fund itself, meaning that in year 6 and 7, your capital calls for the new commitments you make should, in theory, be covered by the distributions you're getting from your first and second year of funds. And in order to do that, this is what endowments do. They invest through cycles. Now, certain cycles like this, they may be hindered to a certain degree because they have their asset allocation that's now out of whack because their public markets went down significantly in 22, but the private marks didn't mark to market, so they were over allocated. So they had to, thin certain positions and call in certain ways, but they're still actively allocating. They're just allocating to fewer managers and to the managers that have actually performed, and maybe divorcing some of the managers that haven't. And so you're right, time diversification, the number of managers that you do, it's if you want to mitigate risk, do you really want to pick one manager a year? Or is it better to pick, 4 to 6 managers that are complementary to each other to really get that level of diversification, to get those outlier companies in any one portfolio?
Yeah, and I think another reason many of us are excited about platforms like Allocate, for example, is, as you said, maybe is it better to have 4 or 6 managers? In general, going back historically, that would require an enormous amount of capital, not just to get access to someone that's good up front, but to actually get diversified exposure to the asset class would be, tens of millions of dollars in all likelihood, especially if you're talking about times in the market like 2021, where everyone was trying to put more money to work in venture. And so maybe the general partners of these funds might up the commitment amount or whatever that is to actually get access to the fund to begin with.
Yeah, and it's also a little bit restricted by it's a relationship industry, so it's not just showing up with a check, but it's will the manager grant you access if they don't know you, because what they look for is this person going to be a long-term capital provider for me, fund after fund? Do they really understand the asset class? Or are they going to be asking me questions constantly about every single investment? And third, are they somebody that, number one, is either bringing a great quantum of capital to me where they can meet those 10 or $20 million checks, or they're adding value in some way. And those are the 3 things that are necessary. But even a $100 million family office, if my venture allocation target is 10%, that's $10 million. Maybe I want to invest that over 5 years. That's $2 million $2 million per year. And let's say I think 5 managers a year is good. That's only $400,000 per check, which means you're going to be limited to a certain universe of GPs that are going to let you in at that amount. And that becomes really hard. Or you're forced to write a check that's too big into a manager where they say, we'll take you if you do $1 million, but now it messes up your portfolio diversification and construction. And so our view is that shouldn't be the case, and that somebody that with $2 million a year or $1 million a year should have the same opportunity to build an institutional portfolio like a $10 billion endowment, with check size minimums that can be as low as 100,000 to align with the person's own portfolio construction model. And venture typically is a smaller asset category relative to public equities, fixed income, even private equity. We see families between 5 and 15% in VC.
Yeah, I think that sounds about right. And in general, fund of funds can be, a good way to do that too, where they're in of themselves providing diversified access to a number of those different venture funds. So it takes away some of that work, but there's a huge range. And I want to quickly touch on that, is just the different ways to access. I think people relate things back to public markets in a lot of ways, because that's where a lot of data is. That's where the access is. You can either buy individual stocks, you can buy ETFs, you can buy mutual funds. There's a couple other formats here and there that are a little bit less well known and underutilized, I would say. But in general, in venture, you can do a direct investment, a special purpose vehicle or SPV, co-investment. You can invest directly into a fund like we've been talking about. there are fund of funds. So there's this huge array of different formats that you can actually use to get exposure. So could you touch on some of those quickly? I think what's prevalent or useful for most people. I don't think in general a lot of folks are really investing directly in those companies just because they may not have the network. But how do you think about each one of those ways? And is there at least a preference from your viewpoint?
Yeah, it's interesting that you say that. And I was actually shouting for the rooftops for a number of years where people were actually doing direct deals.
Mm.
And one of the questions that I ask people is, okay, you're sourcing a deal. Maybe you hear from your network wherever you're located. And the question I always ask people is like, well, why did you see that deal? You have 4,000 active VCs. That if it's come to you, there's a chance that it's been passed over by the institutional investors who are easy to find for an entrepreneur. And so a lot of people did that and they went backwards. So typically, if you're entering into an asset category, you want to go risk off as much as possible. You want to mitigate as much as you can. So if you look at the continuum of risk within VC, you're right, there's different flavors. And it goes from, direct investing, self-sourcing. The next level is you invest with a sponsor. A sponsor brings you an opportunity to invest in a company alongside them. Slightly less risk. Then it's investing in an early stage seed fund. Then it's investing in an established manager. Then it's fund of funds, right? Fund of funds, typically will invest in 10 to 15 managers. So you're getting access to 300 to 500 companies. So while you might be inhibiting your top end upside where with a single company, if you hit the lotto, you might get 100x or 200x, but you're much more likely to get a zero. With the fund of funds, 2 to 2.5x net is kind of what, a lot of fund of funds will, try to look to get, but it's de-risked because you're across many managers that have been diligence that complement each other. And a fund of funds is great for somebody that's getting in that doesn't have the time, right? So do I have time to look at 10, different deals, and deeply diligence them? Do I have time to meet with 200 managers a year? The diligence process can take anywhere between 40 and 60 hours of manpower, given all the things you have to qualitative and quantitatively do. So the view is for the individual, how much time do you have and what is the level of risk that you want to take on? So fund of funds are very popular within the institutional and non-institutional space. Now, the knock against fund of funds has been the extra layer of fees. There was a great report by the National Bureau of Economic Research that showed that venture fund of funds actually earn their keep much more because it's about accessing and finding and discovering the most interesting managers, which discovery today is just as important as access. Like, how do you find the next initialized capital or the next forerunner? Well, most people listening to this podcast probably haven't heard of either of those funds, but those are firms that were founded in the 2011, 12, 13 timeframe, had extraordinary returns. But you have to be in the market to be able to find those. And so, that's sort of the continuum. Fund of funds probably makes sense to start, and then at the tail end, once you have a level of understanding conviction, then maybe it makes sense to start doing direct deals.
And one thing, just to shift gears slightly here, that people are asking us about all the time is, hey, what's the best way to invest in AI? And our obligatory AI section here. But what's the best way to get access to that? I understand that while valuations were very, very lofty in 2021, many of those have maybe normalized now. Maybe AI is the exception to that rule today, where people are seeing, huge valuations with little revenue. But what is your sense, and for someone having their feet on the ground in this space, what amount of assets are actually flowing there? Are people being a little bit more cautious, and these are just kind of one-off anecdotal things that I'm maybe referencing right now? But where do you actually see dollars flowing, and what's portfolio composition look like as it relates to AI-focused investments?
So, I mean, AI means a lot of different things and people confuse it. So, but when we look at sort of the broad lens of AI, the one statement I'll make is I do think this has the opportunity to be bigger than the last tech super cycles we saw, mobile, cloud, and internet. I don't think there's any question about, where this is going. Now, in terms of the trend, we've seen trends get overheated in venture capital over and over again, whether those things like Web3, drones, in the in the late 2000s, it was about clean tech, right? So there's these areas of incredible investment. And when you have that supply of capital going into a certain sector, you tend to have valuations. You have marginal companies that are founded. So a lot of companies that have been founded candidly within that call themselves AI have very little defensibility. And I do think a lot of these companies have raised so much money so early on without any clear sort of application of how they're going to win long term. And so, yes, we are very skeptical of investors that are doing AI actively that really don't understand it, don't understand the defensibility. I mean, if you really want, to win an AI, go invest in Google or somebody, one of the big players who are building the biggest models where other companies will build on top of. So I think you have to be very, very cautious. It's the cool thing right now, and it's been cool because of OpenAI made it possible for people to see the power of it. But at the end of the day, we're still a long ways away to understanding the application, who has a defensible moat, where there's going to be real, meaningful value driven. So AI is overfunded right now. There's a lot of companies that are good, might be good companies, but they're not good investments.
Hmm. Great. And are there any other sectors, verticals, things like that are on your radar that you're excited about outside of that? I mean, what's top of mind for you? What do you get really amped about when you see uh, VCs putting money to work in a certain category or area?
Yeah. I'm not really a sector focused where I'm looking at, hey, this is a sector that you should do. I mean, if you were to ask me specifically, are there areas that I do think there's a lot of innovation ahead of us? I do. I think there's healthcare. I think healthcare right now, in terms of therapeutics, in terms of early detection, in terms of figuring out new ways to actually cure illnesses that have not been cured yet. I think there's a lot of progress there. I think climate tech is also quite interesting right now. Again, that's an area that we want to get deeper, but it's very clear that there's a lot of tailwinds. And then when we think about AI, it's really just this notion that there's so much data that's sitting on the cloud, and how do you harness that data in a way to not replace the individual, but to augment the individual. And so those are three areas that I think a lot about. But at the end of the day, when we're investing in a fund, I just want to know that the manager really understands the space that they're in, and they're investing in companies that potentially have large, meaningful exits that could happen. So if somebody's just doing, for example, they're investing in dog sitter technology. Like that's not going to be interesting because there's not enough there. But enterprise, we're still very excited about in terms of where enterprise is going to go. I think AI within the enterprise is going to be large. But look, I mean, I think with anything, it's hard to know exactly what the world is going to look like 3, 5, 7 years from now. So we look to pick managers that can see and peer into the future.
When you started investing in this space, what was maybe something that you messed up early on, or something that you didn't know that you really wish you had known sooner that you now do, given your 20 plus year experience and exposure to venture as an asset class?
Yeah, I think that it's a good question. And, there's a lot of learnings. Everyone makes a ton of mistakes. I've made a ton of mistakes investing. Sometimes I've just indexed too much on the sales pitch versus actually going really, really deep into thinking about the business. I think from, the standpoint of like myself, I think I just fell in love with analytics and diligence over time. And too often people diligence based on who else is in the round or who else is in the fund. And it created these biases for me that early on I would do it just because somebody that I knew and respected showed it to me. Or, somebody that I knew that was a name brand that was in that particular company or fund. And I kind of realized that their risk return model is very different than mine. And, if someone like a endowment is putting $1 million into a fund, and I'm doing it because I know Harvard or MIT, well, they might just be putting a small toehold to get optionality into a fund manager, not because they have high conviction. And so I have completely, taken away, who I don't care who's in the round, I don't care who's in the fund. I'm going to do the analysis, and maybe afterwards I'll ask the question, but after I've already made the decision. And so I think we too often have our biases driven by like the network that's given it to us versus doing our own work.
Yeah, and I'll add one to that list, I suppose, and see what your thoughts are here too. But there was a company called Toast that you're probably familiar with that do
I am.
point of sale solutions and software for restaurants that I had invested in, and just as a product of when they were going public, it was basically most top of the market it possibly could be. And in general, when these companies go public, you're subject to really a 6 month lockup period, where during that lockup period, the price of the stock actually did phenomenally well up until a certain point in time. And before the lockup expired, ended up, crashing and burning basically. Still around today. It's not like the company's gone under or anything. And I think they're doing all right now. But in general, I think one of the big takeaways that I had that I will absolutely employ in the future, and I'll caveat this with, if you don't know what you're doing, don't necessarily go out and just start throwing stuff at the wall. But, after that period of IPOs actually taken place, if that's what happens with the company, just paying for some protection and maybe buying some put options, for example, to protect some of that position and managing those through this lockup period could be hugely valuable. And of course, that does erode some degree of the return because you're paying for that protection. But at least having that, so if you do have, some notable gains, at least making sure that those are protected to some degree while you wait for that lockup to expire.
And there's different ways you can, do that. I mean, some people will
Sure.
say, in even the private markets, you should actively look at secondaries and look at taking money off the table. I'm a big believer you do that if it makes sense, right? So you have to have your own mental model. We ask managers all the time, under what situations do you hold public stock, even after the lockup? In what situations would you actually sell in a private round? In hindsight, the rounds that were done in 2021, if every venture fund sold their entire position in that late stage private mark, they would have done really well. The multiples are massive. Companies are raising at 1, 5, 10 billion. Many of those companies will never sniff those valuations. Some will, but that's probably 10 to 20% of the companies. So I think in the world ahead of us, secondaries and thinking of ways to mitigate at the top end are going to happen, either through early sales or, as you said, through hedging techniques post public offering.
Yeah, and I think important for people to note too, that's a great diligence question to ask up front if you're talking to someone in the venture space about what their plans are to sell any shares in the secondary market, if that is, and under what conditions they would do that, because it is, if you are in a fund, at the GP's discretion, you may not have control over that dynamic. So understanding what that off ramp would look like upfront is hugely important.
One thing, since you brought
Before
up
we wrap up here,
question.
Samir, I want to just ask, this is something that I've spent a lot of time thinking about every week, but given you're a CEO, your time is limited, and you want to be very intentional about your information flow. What are the top few either podcasts or newsletters or sources of information that you look to for signal or to really inform your decision making on an ongoing basis?
So I don't necessarily have one single podcast that I listen to. The ones that I really enjoy, I really enjoy Invest Like the Best. It's a guy named Patrick O'Shaughnessy. I've listened a lot to The Compound by Michael Batnick and Josh Brown for more macro. They just have a very unique sort of lens, and they have great guests on. I do listen to Ted Seides, who is capital allocators. I think that's an interesting one. All In podcast, when it's non-political, I enjoy it. And then I think 20 Minute VC, when they have certain guests, those are the ones that I like to listen to. And from a reading standpoint, I consume a lot of information through LinkedIn, Twitter, Medium, The Information, the Wall Street Journal. So usually about 30 to 45 minutes a day, I'm just focused on consumption of content to help further my thinking and maybe challenge my thinking in certain ways.
Great. Well, I appreciate those. And how about yourself? I know that you're active on Twitter, on LinkedIn. Where can people find you? I know you have your own podcast, Venture Unlocked, that people can and should go listen to because there's some phenomenal content on there as well. But anything else you want to call out specifically?
Yeah, so I have been writing and producing content for about a decade, typically on my Venture Unlocked Substack. So it's ventureunlocked.substack.com. That's where all my podcasts are. I also am active on Twitter at Samir Kaji. And then on LinkedIn, I tend to be a weekly poster on the world of alternatives with a specific focus typically on venture and private technology.
Well, this has been awesome, Samir. Thank you very much for joining us. I think there's some solid takeaways in there across, how people should think about getting access to venture, fund of funds, what they can do as far as, time-based diversification and other risk management techniques. I think some great parting gifts that you left everyone there as far as other resources and reading and information goes. So thanks for coming on. We really, really appreciate your time.
Yeah, Sean, thanks for having me on. Hopefully this was helpful and, really appreciate the great questions.
Great. Thanks so much, Amir.